Hello friends. In today's lecture, we'll try to understand the role of Reserve Bank of India in forex management. You see, RBI is the apex bank of like Indian banking system. They are the regulator at the top. They are like a principal in a school who is accountable for the overall performance of banking sector in India. So RBI is an apex authority to deal with foreign exchange. They evaluate and appraise Foreign Exchange Management Act periodically to bring in any of the needful changes in the given uh, law. Now you see, forex is actually short form of foreign exchange. So we are mainly dealing in foreign exchange, and that to commercial banks and authorized dealers are the main player in forex market. Now you see, there are so many parties who are directly or indirectly involved in foreign exchange, but main role is for central bank to bring in a policy which brings in stability, ensures liquidity, and fair valuations of foreign exchange transactions across the country. Now, it indirectly influences your economic growth. Now, you see, the main objective of forex management for any apex body is to ensure exchange rate stability. Means Indian rupee as compared to global leading currencies, it should be somewhat stable. Okay, if a currency appreciates is good for country, but if country's value is depreciating, is is not considered to be good. Now you see, we expect India to grow and maybe joining the developed nations shortly. So what you need to do is like you need to have a very dynamic market where your regulators are like having an autonomous role, and their intervention in market is not expected at frequent interval. So from developing to developed nation, there's this transition will have your system in place to mature a bit more than what you have in current context. So you see, when it comes to forex management, the major role of RBI is to ensure stability of currency. Second is like to have reserve accumulation, because India is mainly a import oriented country where you have to bring in lots of goods from outside. The two major components is crude oil and gold, where you are the biggest consumers. So now you see, what you have to do is like you have to have reserves, or you need to have forex reserves so that you make your payments, and you have your resources available at your disposal to take your country forward. Okay, so approximately 600 billion US dollar is the foreign exchange reserve of India. Now it's bit comfortable, but imagine if things go wrong and market is having adverse environment. You see, this 600 billion dollar may be wiped out very shortly. Okay, and you see, government or your Reserve Bank of India cannot control valuations of your local currency in comparison to global currencies. So there are various events which may have an impact on your valuation. So reserve is one. Next is like liquidity management. Now RBI has to ensure that whatever currency is required or is needed by business houses, it should be available in sufficient quantity. Else, demand and supply phenomena may have a check and may have some artificial in inflation or artificial enhancement of some of the currencies. Now you see, hence RBI will ensure currencies are available all the time as per the need of the market. Now you see, the regulatory framework for foreign exchange transactions in India, which is set up by RBI, mainly consists of three things. One is FEMA, which is Foreign Exchange Management Act, the law which has came into existence. It is the updated version of FERA, Foreign Exchange Regulation Act. Now you see, the previous model has been revamped and modifications have been brought in, looking into the change in your environment. So management is better than regulation. So now we have brought in various parties to collaborate while framing these laws and regulations. Okay, so the regulatory framework for forex transaction for any of your allowed operator in India is FEMA. So you need to refer the guidelines from FEMA. The provisions mentioned there in FEMA will be kept as underlying principle, and accordingly you can do your transactions where foreign exchange is involved. Now, next thing which is very important in foreign transaction is like you see RBI enforces strict KYC norms implementation for people who are dealing in foreign exchange. Now, this is brought in only to ensure that there is no money laundering happening here. Okay, to prevent money laundering, know your customer guidelines are very, very strictly implemented for this particular forex market. Next is like reporting requirement. Whatever transactions are being dealt, maybe you buy it or you sell it from an authorized account. You see, all these transactions are kept under watch by RBI. So proper monitoring and regulation is going on just to ensure that you do have a fair market where, like you see, there is no manipulation or uh, like any artificial interruption is there to bring in gain to only few selected parties. Okay, so market is supposed to be kept open for everyone with same valuations. Now you see RBI policies for foreign exchange is actually bringing in market stability. How they bring in market stability is like you see we do have a policy called as monetary policy. In monetary policy, RBI tries to control the liquidity supply in your market, local market. Okay, so if they find that in like you see in local market liquidity is not there and there is a crunch going on, supply is hit. So what they do is like they bring in additional supply, so they inject capital or cash into market to improve the supply situation, and hence you see market will again see movement. So same is the case reverse. So if they see extra liquidity in the market, so they start extracting funds out of the market. Now how they do it? They do have many techniques. Yeah, it is quantitative technique which is mainly in discussion. Quantitative techniques involves repo transactions, bank rate. You do have you see uh, you do have CRR and SLR transactions too. CRR stands for cash reserve ratios, SLR stands for statutory liquidity reserve. So through any of these four quantitative techniques, RBI can either inject or extract excess liquidity from the market. Now you see any sort of excess liquidity will lead to inflationary movement in market. So they'll keep a check on it. Now you see here mainly our discussion is in the context of foreign exchange. So central bank very frequently will try to either buy or sell foreign currencies to ensure that rates are stable. Okay, so they'll do this is what is called as administrative pricing mechanism. So they will artificially involve in certain transactions to bring in stability. Now you see what will happen is like Indian players may require to either buy or sell currencies as per their requirement. So India, let's say India is under the supervision of Reserve Bank of India. So they'll try to ensure the rates are stabilized in Indian context. Imagine if something is happening outside India. RBI don't have much of control outside India. So what will happen is like RBI will try to use whatever means they do have to ensure that you do have a stability inside India. They'll try to bring in administrative interventions periodically to ensure that you see rates are well in check. Next is like capital control measures. RBI may bring in some capital control measures. What it means, like when you are trying to extract foreign exchange from India to some foreign country, like you're going out on immigration and you're taking some foreign exchange along with you. So they may put in a check, or maybe on a like let's say a tour that you are willing to go with your family members. What cash can you take or what you can spend outside India? They may put a check on it. Medical treatment, they may put a check on it. So when they put a check, the reason is like you see, you should, central bank should have proper control on your inward and outward movement of your foreign exchange. Because if you don't have any control on this, you may land up into a very disastrous state. Okay, so what they do is they are just bringing in this policy to ensure that whatever is the basic requirement of citizens in India, it is all met, and in certain exceptional cases also, wherever there is an approval required, they do approve it looking into the evidence. So capital controls may be sometimes put into place by RBI to make like to bring market into stability. Next is like you can see the picture of Mr. Shakti Kanta Das, who is the current governor of RBI. Now you see RBI's intervention in foreign exchange market is just to make sure that you do have conditions which are conducive for business. RBI closely monitor foreign exchange market rates and will try to map it with global rates and if something is unusual, they'll try to monitor it closely and will take certain administrative measures to keep things in check. Now, you see, this is what is the role of a regulator. If you are the principal of a school, it is your duty to ensure that everything happening in your market, in your school, is within your control. You'll try to step in, will try to control the supply. If it is excessive, you'll try to control. If it is less, you'll try to bring in additional by bringing in injection. Now, you see, this is what RBI is doing it proactively, very aggressively. Okay, so buying and selling of currency. If you have to sell something, you will get buyer. If you have to buy something, you'll get seller. So the role of an RBI, a role of RBI in foreign exchange market is like a jobber. So he has, this institution has to act against the market condition. So whatever you do, and you need a counterparty, and that counterparty is not available, RBI will step in and will do the needful. Okay. So market making is what is the role of Reserve Bank of India. Buying and selling currency, in other words, is called as market making. RBI is here for market making. Now you see, RBI is one of the subsidiary. Okay, so if you see globally, Federal Reserve may be a senior partner. So they are all partner in this foreign exchange business. Adjusting monetary policy that we discussed just now, bringing in a rate change will bring in a tremendous effect on your market. Money supply can change and it will have an effect on the rate of interest. Monitoring and reporting of foreign exchange transaction. Now you see, as a financial institution, every financial institution who is undergoing foreign exchange transactions are required to report their transactions on periodic interval. RBI is going to collect these reports, transaction reports, and will be reviewing it. If there is something unusual, they'll track it and will may ask institutions to give their explanation. And if something is unusual found, they may put in monetary or non-monetary penalties on to the intermediaries. This is just to make sure everything is, this game of foreign exchange is played with the all norms set in place. Data collection. RBI is frequently collecting data regarding buy and sell transactions that are happening related to different currencies. The ultimate goal is to ensure that you do have transparency all across and you are able to track the various market trends and you are able to identify the certain potential hazardous situations that are upcoming. You are able to predict. So prediction is only possible when you have data, and this data should be available to you in real time basis. You see, bank to bank information may not be shared, but bank to reserve bank, teacher to principal, information is must. So RBI collects this information to R&D and figures out what is lacking, and wherever there is a, like you see, any sort of shortfall or any practice which is not appropriate for market, RBI will immediately inform the related stakeholders for the same. Surveillance mechanism, you see RBI, because they are the central authority, they have put in lots of surveillance mechanisms in place to identify any unlawful foreign exchange transaction. You see, let's say if you're doing some speculative foreign exchange transactions and you're not reporting them in your income tax returns, you see, if it comes to RBI's notice, you are going to get screwed up for the same. So their role is to make sure market is stable, and people who are actually entering into forex market, they're actually disclosing it everywhere. So you see, wherever it is required to, so that you have a transparency. You do it, no problem. You make money or you lose money in these foreign exchange transactions. But if something goes wrong, you are accountable for the same. You have to, if you're making money, you should pay tax. If you're losing it, you should show it in your ITR return. But if you don't do it, then they are supposed to give you a show cause notice. Now next is like how you bring in liquidity in your market if something goes wrong. Liquidity means if supply is required and you don't have supply, demand is only there, supply is not there, will have influence, negative influence on your rates. Rates may go up, local currency valuations may go down if you don't have that foreign currency available. So how you do bring in foreign exchange liquidity is through repo transactions. So you see, buy and sell transactions are happening between bank and RBI regularly for foreign currency to ensure that you do have sufficient supply available. Next is, you can go into derivative contracts like currency swaps. Central bank engage in currency swap agreements with other central banks. So if you need something in local market and we don't have it, like you see yen is not available, so Reserve Bank of India can enter into a contract with the Central Bank of Japan and can arrange the needful security because they are central authorities. So they enjoy special privileges. So you'll get the help as and when needed. Next is liquidity injections. So they may bring in special tranche of funds maybe in foreign exchange as and when required, so as to avoid any disruption in your market. So if supply is required, they'll bring in from your international market too. So what are the challenges and future outlook? Global volatility, market is very volatile, especially during COVID. It was a bit negative. Foreign exchange due to now you see there are some countries who are fighting war, Ukraine, Russia, and on the other side Israel, Palestine war is going on, and other countries are preparing for it. Now you see what is this? This all leads to global volatility, may have severe impact on the valuations of different currencies. Next, technological advancement. So RBI is trying to keep pace with what technological innovations are happening in your market. Okay, because if you are a regulator, you need to ensure that proper monitoring and supervision is done. How will you monitor if you don't have the latest technology? Maybe people who are into private setup, they are investing heavily and bringing in certain technologies which are very advanced, and if regulator themselves don't have this technology understanding properly, how will you see you check it? Okay, like you see we now discuss it in cryptocurrencies. Bringing in a cryptocurrency mechanism in place is very important, but let's say if you don't have it, you don't have an understanding, you don't have technical expertise team to deal with it, how will you counter this thing? Okay, you will not be able to monitor it properly. So monitoring is very important for a regulator. This is again a big challenge. With the advent of new technology, you have to incorporate all those technologies very fast. You need to get all your technical staff very fast. Now you see sometimes you don't get technical staff available in market easily. So hence when you lag on some resources which are must and you don't have it in your disposal, in your portfolio, then that is what is dangerous situation. Next is, you see these central banks are very vigilant. They should be very vigilant on the current happenings in various market conditions. So you see cryptocurrency is rising like anything. People, youngster, especially the youngster lot, they're investing lot of like their savings into cryptocurrencies without knowing about their future, like valuations and all. It is all you see the predictions are going on. Who is doing it? All investors, young investors. They are listening to so many experts online through various social media channels, and then they are following the pursuit. So it may have a negative impact if regulatory framework brings in a check on cryptocurrency or these currencies. The valuations of these alternate investment class asset may go down tremendously and have a negative impact on the market. So it's always important that regulators should keep on creating financial awareness on these issues and update the youngster lot so that they don't fall into any trap. Hope you understand the given concept. Thanks for listening. Good day. Take care.